Hi, Ron Chakler with American Portfolios. I guess the title of this video pretty much says it all. What a difference a year makes. Wow, since I started making this video series in 2008, we've been through the worst economic and financial crisis since the Great Depression, the steepest stock market decline since World War II, the biggest cut in dividends since the 1930s, followed by the fastest stock market surge in 70 years. It's precisely this volatility that I've spent a great deal of time discussing in previous videos, and the importance of understanding, in many cases, how the stock market doesn't follow the economy, it leads it. I suggest you look back on my emotional investing video, which reinforces the theory that many times it's darkest before the dawn. For this video, I thought I'd do something different and invite a guest to join me. I am here with my fellow American Portfolios colleague and good friend, Allan Wasserman.
Okay.
Allan practices for 15 years in Los Angeles, California. And if some of you are looking at Allan saying that he looks somewhat familiar, he probably is. Because in addition to being an advisor, Allan is an accomplished actor who has played many roles in TV shows such as The Sopranos, Curb Your Enthusiasm, The Office, Boston Legal, and on and on.
I need you as an agent. It's terrific.
Allan has actually been also on the big screen opposite Matthew Broderick and recently playing Adam Sandler's doctor in Funny People.
You are my agent going forward. That's
it is certainly a pleasure, and I feel honored to have Allan with me. Good to have you.
That was terrific.
Well, although we would like to talk about acting, which I'm sure is a little bit more exciting, this is a financial video. And I would like to start off with, because we're in a recovery year, we have many uncertainties that are still out there. You know, the weak home prices, the unemployment figure, and nobody really knows the consequences of the potential for the stimulus packages, which has just ballooned our national debt. How are you positioning your clients for 2010, in light of these uncertainties?
Well, I have to go back a little bit because what you were saying earlier really made sense about we were in the worst situation possibly in the past 15 months. And about 15 months ago, the Dow was at its worst, let's say about 7,000. Would that be fair? So at that juncture, a lot of people who were pounding tables saying, get out, jump out, it's going down to 4,500. I didn't believe it. And you have to, like any business, you have to have a certain amount of instinct. Not just, based on fact, based on experience. I felt it wasn't going that direction. So how I prepared myself for now was 15 months ago, I was buying my clients good quality stocks, good quality mutual funds where they could go home at night, not look at this and go, oh my, what did I just buy? Things they understand, things that have a national presence, things that have an international presence, things that were trading at a discount and not a premium. And so the market did not go down to 4,500. It went down from 7,000 back into the 10,000 range, which, by the way, right now has got me a little nervous. The air is a little thin up here. Maybe you'd agree. But I really haven't changed my strategy since I started doing this, which is to buy quality, to be willing to hold, to try and do some market timing, not be a stock jock, not be a genius. I'm not a Wharton School of Business graduate, but I have common sense to put people into situations that they can really understand and are appropriate for whatever their portfolio needs are.
Every time we go through these markets that are very tumultuous, we've been through two markets in the past 10 years where we've dropped almost 50%.
Right.
And every time they say it's different, and every time, as we know, they never think the market's going to come back.
Right.
But there's remarkable similarities between 2003 and 2009. I brought an interesting chart to show you, and if you look at both years, you'll find they both started around the 900 level. They bottomed out in March, very surprisingly, only 2 days apart, and we wound up closing the year only 3 points apart, 11.12 versus 11.15. And when we look at these charts, they're almost identical. So we see 2003 and 2009 being very, very similar. Also, both years saw falling dollars and rising commodity prices. So what I'm looking at for 2010 is somewhat similar to what we may have seen in 2004. We cannot say for sure, but there's also similarities that took place in 2004 that I think we can see in 2010.
You're seeing a trend, a repeat trend, in other words?
I think one of the important things that we have to look at is how the Federal Reserve acts. In 2004, and it's always using their language, in 2004, they used the term considerable period to keep rates low. This year, they're using the term extended period. I would really be very cognizant of watching when they remove that term, extended period, to signal that interest rates are going to go back up, just like they did in 2004. Also, I'll note politically, 2004, we saw Republicans picking up seats in both the House and the Senate. And that could also happen this year, too.
Starting to repeat itself again.
Yes.
And so how do you think that affects things globally?
Well, I think the evening out of power will certainly help the market stay calmer. That's not to say we know for sure. 2004 did see the second leg. We gained about 9% that year. And the similarities were just too much for me not to at least mention. So, Alan, when you're looking at companies, do you primarily stay within our shores in the domestic companies, or do you look elsewhere?
Well, the way I solve that is, yes, I start exactly that way, because my client base seems to be more comfortable with American-based companies that business emanates from the 50 states. However, I don't want to be so small-minded, neither does my client base. So the way we try to get international is find American companies that have an international presence, and that seems to pretty much balance it out.
Yeah, I think people have to understand, as well as the U.S. did in 2009, there were many other countries with much greater returns. I brought an additional slide just to show you how the U.S. ranks. There was a lot of companies that didn't have the exposure to the same crisis that we had. And I think the interesting theme going forward is people have a tendency to stay within our borders. But, history shows that, there's been three major surges in middle-class population. We have the 1800s in Western Europe, we have the baby boom after World War II, and we have China and Japan and the emerging countries, which kind of started about 10 years ago. The impact of this growing middle class in areas like China and India and Brazil is just tremendous. The amount of people that are going to join, that is going to involve investment, consumption, and production will bode very well for even our domestic companies. A company like Coca-Cola, which derives almost 3/4 of its revenue outside of the U.S. So I think people have to understand that the demand for these goods and services internationally is really what's going to spur the growth in a lot of these companies, not just what happens in America. As always, if you have any questions, please feel free to give me a call. Thanks.